Today, we're diving into taxes to help you understand how your tax bill is calculated, what happens when you enter a new tax bracket, and why a tax credit is better than a tax deduction. We're going to use IRS Form 1040 and a few of the schedules that flow into it to help us walk through the tax formula. At the top of the formula, we have gross income, which is all your wages, interest, dividends, taxable Social Security benefits, taxable retirement account distributions coming together to make your gross income, which can be found on line 9 of the IRS Form 1040. The next part of the formula is subtracting any above the line deductions. Well, what are those? They can be found on line 10 of the 1040, but really you have to dig deeper and find them on page 2 of Schedule 1, showing a long list of what these deductions could be. In practice, the most common ones are deductions for contributing to your health savings account and deductions for contributing to pre-tax retirement accounts. If you're self-employed, you can also deduct a portion of your self-employment tax as well as your health insurance. Subtracting above the line deductions from gross income is how we arrive at our adjusted gross income, our AGI, which can be found on line 11 of the 1040. This is an important number for tax planning because many tax credits and retirement account contribution eligibility are based off this number or a form of modified adjusted gross income, which can be calculated a few different ways. So yeah, this is the line, right? We just talked about above the line deductions. Now we're jumping into below the line deductions. So from our AGI, we have to subtract more deductions. And on line 12 of the IRS Form 1040, you see either your standard deduction or your itemized deductions, whichever is larger. If you itemize, that's being pulled from Schedule A. So showing Schedule A, you can see itemized deductions are medical and dental expenses above 7.5% of your AGI. Again, why that's an important tax planning number. Your state and local property taxes capped at $10,000, your mortgage interest, gifts to charity. I think it's important to reiterate that you do not get a tax benefit from an itemized deduction unless all of your itemized deductions are larger than your standard deduction. So now we subtract another below the line deduction called QBI deduction, qualified business income deduction. This is on line 13 of the IRS Form 1040. If you are a small business owner or self-employed individual, you can potentially deduct up to 20% of your qualified business income, which is how we have arrived at our taxable income, which can be found on line 15 of the IRS Form 1040. This is the income amount that the IRS considers when calculating your gross tax, which can be found on line 16 of the IRS Form 1040. Now, to get to your gross tax, they are multiplying your taxable income by your tax rates. And I say rates plural because there are different tax brackets inside of the income tax rates, and there's different tax brackets inside of the capital gain bracket. So if we pull up those two schedules, right, the income tax brackets and the capital gains tax brackets, you can see that for income tax, the lowest tax bracket is 10%. Once your taxable income crosses that threshold, you are now in the 12% tax bracket. And here's where a lot of taxpayers get confused. They're worried about, oh, I don't want to enter that next tax bracket because then I'll be paying more tax on all my money. And that's not how it works. You only pay the higher tax on the new money entering that tax bracket. The US tax system is a progressive tax system. That means the more income that you have, the higher tax rate you will pay. I also see taxpayers get confused on the capital gains tax rates, largely because they look at the capital gains tax brackets and they see, oh, well, I didn't have that much capital gains, so I should fall in the 0% tax bracket on my capital gains. However, that's not the case because capital gains income sits on top of all your other income. So if we had a big bucket of all your income, your ordinary income would be like water and your capital gains income would be like oil because it would float to the top of that bucket. Even if you have a small amount of capital gains, it's sitting on top of all your other taxable income, which is why you may be paying that higher rate. So continuing on, we've covered gross tax, but that's not always what your actual tax liability is, because we still get to subtract tax credits from your gross tax. And non-refundable tax credits can be found on line 20 of the IRS Form 1040. Refundable tax credits count as payments towards your tax, so they're shown on line 32 of IRS Form 1040. Okay, a tax credit is like a tax gift card. If you have a $1,000 tax credit, it directly offsets your tax liability by $1,000. This is much more advantageous than a tax deduction because if you had a $1,000 tax deduction and you were in the 12% tax bracket, that only saved you $120 of tax compared to the $1,000 tax credit that saved you $1,000 in tax. So all else equal, a tax credit is like a tax gift card and a tax deduction is more like a tax coupon. Now, we have finally arrived at the total amount of tax that you owe for the year, which is shown on line 24 of the IRS Form 1040. The total amount of payments that you have made throughout the year shows up on line 33. If you overpaid your taxes for the year, then you will see a refund on line 34. If you underpaid your taxes throughout the year, then you will see the remainder of your tax liability that is due when you file your return on line 37. There you have it. We helped you walk through how your tax bill is actually calculated, what happens when you enter a new tax bracket, and that you're not retroactively taxed at that higher rate on all your money, only the new money that's coming in. And we even explained how a tax credit is like a tax gift card that directly dollar for dollar offsets your tax liability versus a tax deduction is more like a tax coupon. Thanks for making it to this point of the video. Appreciate you sticking around to the end. Please like and comment below what you would want me to cover in future episodes. If you subscribe, I would really appreciate it. Turn on notifications as we're trying to produce these videos on a regular basis. So with that, thank you.